Hi. Today, we're going to dive into three policies every non for profit organization should have, and many don't. And if they do, these policies fall short of their intent. Hi, I'm Joe Blatt. Welcome to Joe Talks Nonprofits. Today's episode is going to take a deep dive into three governance policies that every board should make sure that their organization has and is using correctly. These are conflict of interest policies, record retention policies, and whistleblower policies. We're going to start with the conflict of interest policy. So, why is this policy essential? A conflict of interest policy protects the nonprofits from self dealing, private benefit, and even the appearance of impropriety. Board members and officers have a legal duty of loyalty, meaning they must put the organization's interest ahead of their own. When personal and business interests conflict with the nonprofit's decision making process, the risk is not just ethical, it's legal and reputational. The IRS specifically asks in the IRS Form 990 whether organizations have a written conflict of interest policy. This makes sure conflicts are both disclosed and managed, not ignored. So, why should the boards care? Donors, regulators, auditors, and journalists all look at this policy first when something goes wrong. Even unintentional conflicts can undermine trust if not disclosed and documented. Many state attorney generals rely on this policy when investigating nonprofits. In New York, this is not just good business practices, but it's the law. So, what should be included in your organization's conflict of interest policy? It should clearly define what is a conflict of interest. It should define what a direct or indirect financial interest in a business includes. It should include disclosures covering not only the board members themselves, but family members and close relatives. Also, if a board member has influence, not just ownership of a related party, that should be included as well. As best practices, I would also include some frequently asked questions, a clear explanation of how to report a potential conflict when it arises, and the ramifications of not reporting a conflict to the board. Let's go through a common scenario. Let's say the organization needs to do some needed repairs to their office building, and one of the board members is a construction contractor, and he or she wants to bid on this work. This would be deemed a conflict of interest. Similarly, if the construction company was owned by a close friend or a relative of that board member or key employee of the organization, this would also be deemed to be a conflict of interest. This is why disclosure is so important. In this case, the conflicted board member needs to recuse him or herself from the process and allow the rest of the board to review the bids from the applicants to determine the best contractor for the job. Another detriment of doing business with a board member is since he or she understands the industry, it would be better for the organization if they were able to review the bids impartially and ask knowledgeable questions of the other bidders. Having a clear policy for bidding conflicts is best practice. As an auditor, a few questions I'm frequently asked by board members when they're filling out their conflict of interest forms is, how do I know who the organization is doing business with? Or if my spouse works for Staples, do I need to disclose this? The answers can vary depending on circumstances. Best practice is always to disclose as much as possible. If your spouse is an employee with no managerial roles at Staples and would not benefit from the nonprofit doing business with them, then it's probably not going to rise to a conflict of interest. But disclosing it would still be best practices. Always act on the side of caution. Too much information is always better than too little. A copy of the organization's conflict of interest policy should be distributed to all new board members when they join the board as part of their welcome package. New board members should sign a form acknowledging they received and read the policy. Annually, usually at the beginning of the fiscal year, all members of the board, as well as officers of the corporation and key members of management, should sign an updated conflict of interest form disclosing any potential conflicts. Many of my clients ask me for purposes of the conflict of interest form, who is a key member of management? I usually tell them that they should start with the IRS Form 990. If a person is disclosed in the 990 as a key employee, then they should be one here as well. I would also look at who can make decisions on major purchases and include them as well. They may include the organization's director of purchasing and maintenance director as well. The policy also includes specific procedures the organizations will go through to evaluate related party transactions, including what to do if there exists a related party relationship. For example, if a board member's spouse is a key member of management of an insurance broker the firm is using, who will determine if this constitutes a related party transaction, and if it does, how will it be handled? Organizations will typically have a board member recuse themselves from the process of determining whether to engage the insurance firm. They will also require competitive bids to verify that the price they are paying is at or below market value. This is important because most government oversight agencies will assume it's not and will require you to prove that it is. New York State and others might even require the related party to repay the organization the full amount if the organization can't prove they bid out the services. Both the IRS, as part of the annual Form 990 filing, as well as generally accepted accounting principles, as part of the financial statement disclosures, will require that material related party transactions be clearly disclosed. So it's important to track related party transactions throughout the fiscal year. It's important that each year the audit or board chair review the signed conflict of interest forms. As an auditor, I had to report to boards when organizations were not in compliance. Board members would forget to sign the form and no one would follow up with them. I also saw years where boards forgot to circulate the forms completely. This process should be ingrained in the responsibilities of the audit committee. One of the roles of the audit chair should be to make sure that all statements are signed and returned in a timely manner. Having a policy and ignoring it is worse than not having one at all. This policy doesn't mean conflicts are bad. It means pretending they don't exist is dangerous. The second policy we'll go through is the document retention and destruction policy. This policy defines what records are kept, how long, and when they may be destroyed. It is especially critical during audits, lawsuits, grant reviews, and IRS examinations. The IRS includes this policy in the Form 990 governance disclosures because sloppy record keeping, or worse, improper document destruction, can quickly escalate into legal trouble. Federal law makes it illegal to destroy records in anticipation of an investigation. A formal policy helps organizations avoid that risk by setting clear rules and automatic retention schedules. The policy should clearly define what records are included. This is not just paper records, but in today's day and age, this now includes electronic files, emails, correspondence, cloud stored documents, as well as other similar items. The policy should establish minimum retention periods. Here, you should make sure that you're in compliance with outside guidance as well. IRS has certain retention requirements, as does the Department of Education, most government and foundation grantors, as well as other third parties. Making sure your retention period at a minimum equals these requirements. When litigation, an audit, or a government inquiry is pending or is reasonably anticipated, all document destruction must stop immediately, even if the retention period has expired. You should also make sure you clearly state who at your organization is authorized to destroy documents. This will prohibit unauthorized destructions of files. This will also make sure that destroyed documents are properly disposed of and establish an individual responsible for the process. This policy serves two main purposes. First, it makes sure that the documents are not destroyed inappropriately. And second, It sets guidance on what documents can get destroyed and when. When all documentation was maintained on paper, I had clients with warehouses full of documents going back 20 to 30 years. They were afraid to dispose of anything, including timesheets and reports that should have been disposed of years ago. This will set a clock for all documents. Similarly, I have a lot of clients who have endowments. Many of them go back 10, 20, or even 50 years. These clients often did not maintain the original donor letters, which document how the endowments were meant to be managed. These documents should have been maintained in perpetuity, the same way as the certificate of incorporation, bylaws, and other governing documents be preserved. Making sure everyone knows this is essential. So, why should boards care? It will protect the organization during audits and disputes. It will support transparency and continuity through leadership changes. It will reduce accidental noncompliance or over retention of sensitive data. I have seen cyber attacks on clients' files where sensitive data was stolen and put up on the dark web. Destroying unnecessary sensitive data would have significantly reduced this impact. Safeguard what you need and dispose of what you don't. The third policy we're going to go into is a whistleblower policy. So, why is this policy essential? A whistleblower policy provides a safe and confident way for staff, volunteers, or board members to report concerns without the fear of retaliation. As part of the annual 990 filing, the IRS asks directly whether nonprofits have adopted a whistleblower policy, because organizations that surface problems early are far less likely to face public scrutiny, lawsuits, or regulatory action. While Sarbanes Oxley doesn't broadly apply to nonprofits, its anti retaliation provisions do. This makes retaliation against whistleblowers a federal crime, regardless of whether your organization has a whistleblower policy or not. Having a whistleblower policy shows the organization takes whistleblowing seriously and educates people on their rights. New York nonprofit law requires certain nonprofits to adopt and implement a whistleblower policy. Any nonprofit organization with 20 or more employees and revenues over $1 million needs to adopt a whistleblower policy. The whistleblower policy should encourage employees to report suspected improper conduct, including fraud, illegal acts, and violation of the organization's policies. The policy should also make clear that there'll be no retaliation against those that report their suspicions. The policy should not only cover employees, but also management, board members, as well as volunteers. The policy should make clear who they should report their suspicions to, how they should go about it, for example, by email, phone calls, etc. Best practice is to have a person on the board or a compliance officer as one of a couple of options available to the whistleblower. You don't want the whistleblower to be afraid to report their suspicions to a person they suspect of committing the fraud. This will not work. I generally recommend the audit chair as the main person and the compliance officer as a secondary option. There's also outside organizations, such as law firms and accounting firms, that can act as the primary group the whistleblower can reach out to. The policy should include who will investigate the complaint, how the board will be notified of material matters. The whistleblower policy, like other policies we discussed earlier, should be distributed to all individuals covered by this policy, including volunteers. No policy is effective if the people who need it don't know it exists. So, why should boards care? Auditors routinely flag the absence of a whistleblower policy in management letters. Many funders expect one as a condition of receiving grants. Without it, concerns often surface publicly instead of internally. Most importantly, did you know that whistleblowers are the number one mechanism that caught fraud year after year, more than audits and any other tool? A whistleblower policy isn't about distrusting staff. It's about giving integrity a safe place to land. These three policies work as a governance system, not in isolation. The conflict of interest policy protects decision making. The document retention policy protects evidence and history. And the whistleblower policy protects integrity and reporting. The IRS has repeatedly stated that well governed organizations are more likely to protect charitable assets and comply with tax laws, which is why these specific policies are spotlighted in the IRS Form 990. If your nonprofit organization only has time or capacity to adopt three policies this year, start with these. These aren't about bureaucracy. This is about trust, transparency, and long term sustainability. If you found this episode helpful, please like and subscribe to my podcast, Joe Talks Nonprofits. I will continue to bring you more governance and finance topics over the weeks to come. Thank you, and I hope to see you again next week with my next episode. This podcast is intended for general informational and educational purposes only. It doesn't constitute accounting, tax, law, or other professional advice and should not be relied upon as such. Laws, regulations, and accounting standards change frequently, and their application can vary widely based on specific facts and circumstances. Accordingly, listeners should consult with qualified professional advisors regarding their individual situations before taking any action. Thank you and have a good day.